seller sold his business, canceled the insurance, moved on. Then his life was turned upside down, putting his entire estate at risk from one mistake. Because a project done 2 years before his business sale allegedly caused significant financial harm to his client. The seller's E&O policy was gone. The business was sold, his home, cars, and cash, all at risk because of one mistake that could have been avoided. Do you know what tail coverage is? Do you know what kind of insurance policy you have right now? Is it claims made or occurrence based? Too many sellers can't answer those questions. I'm going to change that right now because buyers know this, use it, and leave you stuck with liabilities after you sell your business that you definitely don't want. The seller didn't have bad luck. He had a gap a buyer's team knew to look for and to plan for. Here's what buyers know that you need to know. There are two types of liability policies, and the difference between them determines whether you have any coverage at all after you sell. An occurrence-based policy covers incidents that happen during the policy period, regardless of when the claim is actually filed. If something happened while you owned the business and your policy was occurrence-based, you may still be covered years after the policy ends. Solid protection, but generally more expensive. A claims-made policy only covers claims that are both made and reported while the policy is active. The moment you sell your business and cancel that policy, the coverage window closes. A claim that surfaces 6 months later for something that happened 3 years ago when you owned the business, it's not covered. The incident happened during the policy period, the claim didn't. No coverage. Most professional liability and errors and omissions and directors and officers policies are claims made, which means most sellers are walking around right now with a coverage gap they don't know is coming the moment they sign a purchase agreement and cancel those policies. Now here's where your deal structure matters, and this is the piece almost no one connects until it's too late. In an asset sale, which is the most common structure for small business transactions, a buyer purchases the assets of your business. Your LLC stays with you. A buyer forms their own entity, gets their own insurance, and operates the business going forward under a completely different structure. We've covered this in previous videos. That sounds clean, but it isn't, not when it comes to insurance. Your LLC still exists, and your LLC is still the entity that owns the business when every prior incident occurred. If a claim surfaces 2 years after close, a former client alleging your work caused them financial harm, an employee claiming a wage violation from 3 years ago, a vendor dispute over something that happened on your watch, that claim doesn't go to a buyer's new entity, it goes to your LLC, the one you still own, the one you were probably planning to quietly dissolve once the deal was done. Do not dissolve your LLC immediately after an asset sale. That is one of the most common and most costly post-close mistakes sellers can make. A dissolved LLC doesn't make claims disappear. It makes them run directly against you personally, your house, your investment accounts, your cash. Everything you worked to protect in the last video is now fair game because the entity that should have absorbed the claim no longer exists. Keep your LLC open. Keep cash in the company bank account and talk to your attorney about the right wind down time and what you should leave in that LLC that may help protect you for your specific situation. In a stock sale or an LLC membership interest transfer, a buyer purchases the entity itself. Your LLC transfers to them. On the surface, that sounds like your exposure goes with it, but it doesn't work that way. A buyer now controls the entity, which means they control every insurance decision going forward. If they cancel the claims-made policy you had in place and replace them with their own coverage, your historical exposure, everything that happened while you owned it, may no longer be covered. A buyer's new policy covers incidents going forward under the new ownership. It doesn't reach back and cover what happened under yours. This means it's a contract negotiating point, not an insurance one. Before you sign a final purchase agreement in a stock or membership interest sale, your attorney needs language requiring the buyer to either maintain your existing claims-made policies through the tail period or purchase tail coverage on your behalf as a condition of the transaction. If a buyer cancels that coverage and a historical claim surfaces, you need contractual protection that puts that liability back on them, not you personally. A buyer's attorney is not going to volunteer that language. You're going to have to ask for it, maybe even demand it. In any deal structure, the universal protection is tail coverage. Tail coverage, also called an extended reporting period endorsement, extends your claims-made policy so that claims filed after the policy ends are still covered, as long as the underlying incident happened while the policy was active. You buy it at the time, you cancel or let the policy lapse. It doesn't cover anything that happens after the sale. It covers the past, which is exactly where post-close claims come from. Tail coverage typically costs 1 to 3 times your annual premium depending on the policy type, your industry, and the coverage period you choose. It feels expensive in the moment. Run that number against a 6-figure claim that comes in 18 months after you've already moved on. It stops feeling expensive pretty quickly. Phase 2 of the Exit Ready Vault has the Personal Asset Protection Checklist. The Insurance Review section covers every question in this video, organized so you can walk into that conversation with your insurance agent knowing exactly what to ask and what to look for. Find it with the QR code, or a link is in the description. And please subscribe so you don't miss the rest of this. It's part of Exit Ready, my free YouTube course that covers the entire business sale process from cleanup to close. Errors and omissions coverage protects you against claims that your professional services caused a client financial harm. Directors and officers coverage protects you against claims related to how you ran the company, decisions you made, things that happened under your watch as an owner. Both are almost universally claims made. Both are areas where post-close claims are common. If you have either, and most service businesses do, tail coverage is not optional. It's the difference between a closed chapter and one that gets reopened on the worst possible day. What changes the moment you sign a purchase agreement? Your insurer needs to know about the transaction before you sign, not after. Some policies have change of control provisions that affect coverage during the period between the signing and closing. Some require notification of a pending sale as a condition of continued coverage. If you don't notify your insurer and something happens in that window, you may be walking into a coverage dispute at exactly the moment you can least afford one. Make that call to your insurance agent before you sign anything. Now here's the piece most sellers don't see coming. A buyer's team will request your insurance claims history for the last 3 to 5 years. They're not just doing a routine check, they are specifically looking for patterns they can use. A pattern of claims is a story about how your business operates, and a buyer's team knows how to read that story and turn it into a lower offer or longer holdback. An open claim that hasn't been resolved is a disclosed liability they're going to price into the deal. Multiple claims in the same category tell them something about your operational risk that you may not have thought to disclose. And if you don't know what's in your own claim history before a buyer pulls it, you are going to be reacting to information instead of controlling the narrative. Pull your history first. Know what's there. If there's an open claim, address it before you list. If there's a pattern, have an explanation ready, because a buyer's team is going to ask. Here's what to ask your insurance agent before you list. If any are claims made, what does tail coverage cost and for what duration? Does my policy have change of control provisions? And do I need to notify you when a sale is pending? Please pull my complete claims history for the last 5 years. Is anything open or unresolved? And what changes about my coverage during the period between signing and closing? That conversation takes an hour, 1 hour, and it's the difference between a clean exit and a 6-figure problem that shows up long after you thought you were done. If you've watched all 4 videos in this series of Exit Ready, every gap a buyer was planning to find, you just took it off the table. You've cleaned up your financials and tax compliance, documented operations, protected your personal assets, done your pre-sale legal review, and made sure your insurance doesn't leave you exposed after the deal closes. In the next series, I'm covering how to get buyers to want your business, how to spot red flags in the NDA that can kill your business if the deal falls through, and if you need a broker, M&A advisor, or if your deal is a DIY.